My name's Garrett Goggin. I manage and run the Golden Portfolio. I'm originally from Boston. I'm a CFA, MBA, CMT. From the Wall Street community, I work with Putnam Mutual Funds, whereas traditional mutual funds invest for the long term, and I never really believed in that, and I was always attracted to alternative assets. So I started working with John Duty of the Gold Stock Analyst about 15 years ago in Stansberry Research, and just recently I went off on my own and started the Golden Portfolio. And today I got a couple companies with me. I've got John Barker with Longcore Gold and Jack Stock with Globex Mining. These are two extremely undervalued opportunities available to you in the market through my research that I'm able to identify. And today I'm going to share with you some of the ways that I measure value and determine opportunities out there in the gold market. So the title of my presentation is Mining Myths and Opportunities. Basically, we could say this: why major miners are not good investments, but now is the best time in 20 years to invest in the larger cap miners, and I'll explain why later. Now, a lot of people show this chart. They show the price of gold in the white versus the GDX in the gold. Since 2007, the GDX is down 6%. Gold is up 325%. They point at it and they're like, this is an opportunity. The GDX is gonna catch up to gold. Like, it's never gonna happen. You're comparing apples and oranges. Gold is nobody's liability. There's no expenses really associated with it, and it trades off, off supply and demand. The GDX are stocks. The value of a stock is the sum of free cash flow over the asset's life, over the life of mine. Stocks, the free cash flow is determined by revenue, which is determined by the gold price, but then it's offset by corporate expenses, exploration. There's stock dilution that you need to account for. There's a tremendous amount of things. So the GDX is never going to catch up to gold. But as I said earlier, the stage that we're at, the valuation of the gold stocks is a tremendous opportunity right here. We're going to see a good rally, but I don't think it's going to close the gap to the gold price. Most miners are a poor investment. These are large cap miners. These are the big boys. This is Newmont, Randgold, Agnico, Kinross, Pan American. The gold price is in white, right there. Gold price has outperformed almost every major miner since 2003. And if you look at the returns of the major miners since 2003, some of them are actually negative. So, the value of a stock is the lifetime cash flow of discounted free cash flow over the life of mine. So a miner, the large cap miners, they're worth the most on day one of production because they have all the reserves in front of them. They have all the production in front of them. That's the Lassonde curve that I'll talk about. That's why they're valued the highest at the peak of the Lassonde curve, which is day one of production. As they start producing, reserves drop. Their life of mine decreases usually. Yeah, you can add value through exploration, but it's like you're on a treadmill and you need to constantly move forward in order to stay still. That's why the majors have not been a good investment over the past few years. Longer term, 50 years of underperformance. This is gold versus the ASA gold index. And it's, underperformed for 50 years. And it's because of the reasons why. You're comparing gold, which is, nobody's liability, to mining companies, which, have expenses, they've got exploration, and free cash flow. You get major rallies in here that we are at the cusp of right now. But over time, gold outperforms the large cap miners. The smaller cap miners offer tremendous opportunity, and I'm going to explain why and how I find them. Large cap miners would never rise like this. This is home stake mining. This is back in the day, I don't even know, early 1920s, 1930s. George Randolph Hearst, who was a senator, made so much money from home stake mining. He funded his son, William Randolph Hearst, into one of the richest dudes in the United States through Hearst Communications. But his initial fortune came from home stake mining. And this chart, it was driven by increasing economics on a per share basis. It was paying tremendous amounts of dividends. It was increasing increasing production. It was extremely undervalued. It was a small cap stock to begin with, and this value that they created drove the stock price. It was the best producing stock in the New York Stock Exchange over in the decade of the 30s. And I believe we're getting into a time like this, but the large cap miners, the ones that trade at 2 bill or 3 bill or 4 bill or 5 bill, they're not going up 5x, 10x, but the smaller guys, where they offer tremendous upside, those are the ones where we're going to experience charts like this. The reason why gold stocks don't keep up with gold is because when inflation pushes gold higher, it pushes costs higher. Some people hate this chart because it's like offsetting. The tables on the side, one starts at $700 ounce for all-in sustaining cost, and then the other one starts at $1,100. But it proves my point. As gold increases, the all-in sustaining costs and costs, inflation pushes them higher. So, if you look at miner free cash flow margin, free cash flow is basically, it's just all-in sustaining costs. It's gold price minus all-in sustaining costs times the production. Stocks follow free cash flow. You need to track free cash flow. You need to drive earnings on a per share basis, or else your stock price is not going to move. This is a chart of gold miner free cash flow margin versus the GDX index. Notice a correlation. It tracks like identically. The GDX is in gold. The free cash flow margin is in blue. The free cash flow margin is at like 45%, the same level that it was in 2020, even though gold is like close to $1,000 higher right now. So you need to keep track of the profitability. You need to keep track of the margin. An even closer visualization of this is gold miner free cash flow per share, because you need to measure everything on a per share basis because stocks are valued on a per share basis. So you measure free cash flow on a per share basis. Notice the yellow line that is above the blue line the majority of the time. The yellow GDX free cash flow per share is blue. It's above, GDX index is above free cash flow per share the majority of time, but now, see that dip right there? It's below the free cash flow per line figure, and that's only happened 2 times, 2015, 2020, both the starts of major rallies. And the thing that's wild right now is, gold's at $2,700 an ounce. It's an all-time new high, breaking out in all currencies. And people are like, oh, gold's so high. It's not. But then you look at gold stocks. Gold stocks represent a tremendous opportunity right now because they're so undervalued versus the price of gold. We haven't seen undervaluation like this in a decade. Stock price follows free cash flow higher. Agnico's done a good job. The yellow line is, Agnico profits on a per share basis, and the white is the stock price. The profits on a per share basis increases, stock price increases. Agnico's done a good job. A lot of the large cap miners, they buy out the smaller exploration company and they'll pay $300 million. Costs them another $500 million to, in CapEx to build the project. They're in it for $800 million. And then over the life of mine, they never get that $800 million back. It might generate, I don't know, 75 mil, 100 mil free cash a year. But in the end, they're not turning a profit. And I know a lot of you are business people out there. It's like you want to invest $100, get $1,000 back, right? A lot of large cap miners don't do that. They keep production steady. They keep issuing stock for acquisitions. Management get paid, and bankers get rich, and shareholders get screwed. Stock price follows free cash flow lower. This is Newmont Mining. People are like, oh, Newmont this, Newmont that. It's like, all right, it's because their free cash flow on a per share basis, they paid, I don't know what they paid for Newcrest, billions and billions of dollars. So it increased production a tremendous amount. But you need to measure that transaction. You need to see how much free cash flow that Newcrest acquisition is bringing in and compare that to the amount of shares that they paid for that. And you can see that their free cash flow per share is down. Is it in half? Yeah, it's $3 to $1.50. In 2011, it was $3.50. Now it's $1.50. That's why the stock price is half of what it was in 2011. Dilution is cancer. When people say silver, a lot of people think of Core Mining. Core Mining, this is a chart of their share price. Their share price in the late 90s, that's $200 per share. It trades at, this is an older, I should have updated, it trades at like 5 or 6 now. But the stock is down like 97% over the past 20 years. Like, it's an incredible story of just capital destruction. And the reason why is because they're a serial diluter of shares. Shares outstanding have gone from $10 million to 10 million shares outstanding, 382 million shares outstanding. Core Mining just paid, what, $1.2 billion for Silvercrest Metals. Silvercrest Metals turns like 50 million free cash flow last quarter. That's 200 mil over the year. And then Las Chispas, the life of mine's only 5 years, 6 years. So they're basically keeping production steady, but they're never going to get that $1.2 billion back from Las Chispas unless they get lucky and hit a new deposit, a new major vein or something like that. Miners have terminal NAV value. So, being a CFA, MBA from Boston, equity analyst, you need to measure equities, using a NAV table. It just, you are measuring profits over the life of the mine. You are discounting it at 5%, 8%, whatever. And it's like, this is the way the institutional community does it. This is the way they value equities. It's like, don't hate the player, hate the game. This is just why that the miners trade at a low multiple, because in year 10 of mine life, the miners have a depleted asset potentially that it represents a liability. And then you add up the sum of the cash flows over the life of mine. $1 over 10 years is worth $7.72. That's a 7.7 basically X multiple. Now, at the end of the mine life, it's worth 0, so there's no additional value added on. But the tech stocks, the consumer, all the growth stocks, what happens in that NAV discount table is you put a growth multiple on that last year, year 10. And you're like, all right, so the growth is going to be at 3% a year in perpetuity. Apple, we're going to sell more iPhones. We're going to go to India. We're going to go to China. So we'll put a 5% multiple on that. So they take the last year, they divide by the growth multiple, in this case 3%, and they add on value. And look at that value. That's $33.33. That's more than the total value over those first 10 years. So you get a miner worth $70.72, and then you get a tech stock that's worth $41.06. It's just the nature of the business. You have to understand how the market values these things in order to find inefficiencies and opportunities in the market. Miner free cash margin versus free cash flow multiple. As I said, the 10-year discount is 7.7. That represents terminal value. The miners are cheaper than that right now. The miners trade for 6.5x free cash. This is the cheapest they've been ever. It's a total aberration. I've never seen anything like this. And I don't care what anyone thinks about the gold mining or the gold industry. All people care about is making money, especially institutional investors. And when they see the money's on the table, they're going to be coming. And I think the value guys are coming soon, if not now. Good, bad, ugly. Number 1, 3 gold price scenarios that could occur in 2025. This is, gold's going to go higher, Trump's going to do this, China's going to do this, gold's going to go higher. But look at all the things, the bad things that can happen from mining. This is why a mine is worth the most at year 1 of production, because once you go into production, it gets hard. It gets, you're losing value every year. There's multiple things that can happen. But there's a better way to, look at this market and to find opportunities. The golden portfolio, I got 3 products. The GP, right there, GP 10X and GPIV. GP is based off the royalties. GP 10X is smaller explorers, developers. GPIV is my favorite ones. Last year, GPIV was up 156%, killed it. It was great. Based off of, and then, the GP10X was up 44%, GP was up 22%. This is a real portfolio. It's actual buys, it's actual sells. When I buy, cash goes out of the account. I sell, cash goes into the account. And look at the GDX. It was a very disappointing year. It was only up 13%. GP almost doubled it. GP 10X was up 4X, and GPIV was up, 15X. Now, this is regarding the golden portfolio. This is why I started this. Because working with the gold stock analyst in Stansbury, I started looking at the royalties and looking at them very closely. And I'm like, what if you just made a portfolio of royalties? How would you have done? And the royalties would have outperformed by a tremendous amount. But this just shows the performance from last year. GPIV up top, the purple line, 10x. It's all above. I'm creating alpha. I'm generating returns in excess of the GDX. That's what you're looking for. And the reasons why I like royalties drive free cash flow per share. Look at Royal Gold. Look at their free cash flow. It went from 50 cents to $2 over the past 15 years. And there's many reasons why royalties can do this. It's a very efficient way to invest in gold. As I said, royalties outperform gold in the GDX. As you remember, all the miners underperformed, all the royalties outperform. It's simple. It's simple math. My royalty portfolio, I'm like, what if you just made a royalty portfolio? Since 2007, it's up 14,000%. It's 30% of your CAGR. It's better than Buffett. It's better than anything. It's a little boring. It's like watching paint dry, but it's 24 karat gold paint. And royalties just continue to outperform. They're the best way to play gold. And one of the reasons why there's so much alpha in this, all the smaller guys get taken out. There's tremendous ongoing consolidation within the sector. The reason why royalties, are premier investment vehicle. Number one, fixed costs. Number two, diversification. Franco's got 433 assets. All they need are one or two to get lucky, and the stock's going to do great. Leverage, the miners' free cash flow leverage is about 45%. As gold goes up, royalties margins increase because their costs never change. Optionality, you have free exploration, optionality upside. You're paying for the initial life of mine. The exploration is valued in a little bit, but it's basically anything that comes after the life of mine is additional. This is Silicon Merlin, owned by Origin Royalties. It's going to be one of the largest gold mines in production. It just grew tremendously over the past couple of years. It's owned by Anglo. Altius owns a 2% NSR. Origin owns a 1% NSR. And I'm sorry, I'm rushing out. I got 3 minutes left. Number 5, minimal overhead. Number 6, sector consolidation. Abitibi, Mavericks, Ely Gold, Great Bear, Nomad. These are just royalties that's happened over the past 3-4 years. Just ongoing. All the smaller ones, they all get bought out when they have a crown jewel major asset. Now, Globex Mining. Globex Mining is a hidden royalty gem. I love to find companies like this where, they're hard to identify, but, I go through the financial statements and, the MD&As all year long, and that's what I do on a daily basis. And when I see something like this, jump off the table, I called Jack right away. I'm like, is this accurate? And it trades for, $35 million market cap, net debt of 22 mil. They have 20 mil cash in the bank. Jack is extremely frugal. He doesn't like to spend money. He's never diluted his shares. The shares haven't changed over 15 years. They generate $5 million of free cash flow per year. You do the average mid-cap royalty multiple, it's worth 4 times what it's trading at right now. Jack doesn't do any marketing. This is the first time Jack's been on the road, and I'm happy that he's here, and I'm happy to share the Globex story with people. GP10X focuses, this is my explorers and developers, it focuses on Archie's role. Friends with Peter McGaugh, the world famous geologist that discovered Juanicipio Mag Silver's massive silver deposit, extremely high grade, found in his first drill hole. The only thing that moves the needle for producing mines is grade. You see the silver price remains constant over this time. You see tons remains constant, recovery, grade, but look at the production. The production, as grade increases, production increases. Your costs on a per ton basis are relatively fixed in mining. The only way you can really move the needle is by increasing grade. Not all mines have it. And this shows that the break point of profitability is about 250 grams per ton for silver miners. Silver miners that operate under 250 grams per ton, I'm saying this generally because there's a lot of differences in mining deposits, they're not profitable. They're going to have to dilute. Values created by the drill bit. I follow exploration. I follow the grade. If you look in here, this is from earlier this year. And you'll see a lot of the names that have outperformed in 2024 on this list that came out in January. Because once a high-grade drill hole's hit, it continues. You need to prove it out. You need to define the deposit. It continues for years. Value, Snowline Gold. Even though gold had a tough couple of years, well, 2021, 2022, Snowline was able to add tremendous amount of value just through exploration. GP10X finds value in the Trossery-Lassonde curve. That peak right there, that's first production. Right down there, that's after they get financed and they have a mine. Silvercrest Metals fits the Lassonde curve, first production right there. This is one of my picks. It was a free stocks distribution from Silvercrest Mines that I was attracted to because of its free cash flow. Went from 6 cents to $11 before it got taken over by Core Mining. Montage Gold, 500 mil, trades for 500 mil EV. Its NAV value is like $1.8 billion. It's fully financed. On first production, EV is going to match NAV. This is the stuff that I'm interested in. The big gold picture macro outlooks are fine. I try to find the miners that don't need a higher gold price in order to move up in price. I see rising gold as just the cherry on top of the ice cream sundae of the fundamental analysis that goes into the GP. Longcore Gold, John Barker is here with me today. Longcore Gold trades for $50 million market cap. It owns a Dumby, and it's located in the DRC. A Dumby is worth $1.6 billion. Like, it's trading at a 97% discount to fair value, representing 30x upside. You know, these are the opportunities that I look for. 97% undervalued based on EV to NAV. And, oh, good. All right, I'm almost at the end. This is a regression between free cash flow per share and the GDX ETF. Since they're so highly correlated, it's easy to run a quick regression upon it. That you can see the gold miners are near that 20% level. That only happened in 2015, 2020. GDX went on a tear, both times, rising 100% over the next few months. So I believe we are setting up for a major, gold rally here, and offering tremendous opportunity.